Hello everyone, my name is Jonathan Tucker and welcome to today's AJAG online presentation. For those on Twitter, be sure to follow us at AJAGCPD, tweet your questions throughout today's course, or you can use the chat function in the GoToWebinar dialog box. We'll leave some time at the end of today's session as well for your questions. Welcome to today's presentation. It's a special income tax update as a result of the December 7th announcements that were made by the Finance Minister and Department of Finance. Our presenter is Jay Goodis. Jay is a CPA CA with broad expertise in Canadian tax, from spending nearly a decade specializing in tax in public practice. Combining his tax knowledge and leveraging his proven abilities, Jay has created a suite of support tools that focus on solving challenging tax problems and supporting growth of clients for those of us in public practice. Jay is the co-founder and CEO of Tax Templates Inc. Tax Template Inc. develops tax and accounting software for public accounting firms and wealth management firms. Jay, welcome to today's presentation. Great to have you on the line.
Thank you, Jonathan.
You have a full program. As we look at the agenda, you're going to be taking us through a full presentation of the wide range, the sweeping changes that were announced last week, or I should say proposed changes. So Jay, we look forward to your presentation.
Great. Thank you for that kind introduction, Jonathan. I'd first like to thank AJAG for giving me the opportunity to speak today, and for everyone taking the time to attend this webinar. Hopefully each of you will have an opportunity to take some time with family and friends over the holidays, but for now, there are a lot of changes proposed by the new Liberal government last week that are going to impact many individuals and businesses across the country. The purpose of this webinar is to update you on the federal tax changes, to look at how these changes can impact tax planning strategies for you and your clients, and leave you with several ideas that you can look to examine immediately. Well, one of the important things to note about me is that I like to solve real-world examples. Today, we are going to look at real scenarios, improve the tax effects for our clients. There are two key themes for today's webinar: follow the cash and show me the numbers. Many of these tax changes will have a direct effect on the cash flows of our clients. So it's important to understand the changes and calculate the value of key differences. Let's also remember the time value of money. There are going to be absolute tax costs or savings that we are going to see today, but that always has to be considered in the light of potential tax deferrals and the time value of money. Let's begin by looking at the individual tax changes starting January 1st, 2016. We will discuss the corporate tax changes after. I trust everyone is very well aware of these changes, so I won't spend too much time here. There is a new federal tax rate of 33% on taxable income over $200,000. The new 33% tax rate also affects inter vivos trust and split income, such as the kiddie tax. There's also a reduction to the tax rate from 22% to 20.5% for taxable income between $45,282 and $90,563. Today we'll be looking at clients above and below the $200,000 threshold, as opportunities do exist for both. One key observation about this change is that it was promoted by the new government as tax savings for the middle class. However, every individual in a higher tax bracket will also receive the tax savings from this change, the drop from 22% to 20.5%. Once you take this tax break into consideration, individuals begin paying higher taxes when they earn over $202,058. The new donation rules were a bit of a surprise. Starting in 2016, a donation tax credit of 33% is available on taxable income in excess of $200,000. We'll look at an example shortly. One important note, this only applies to donations made in 2016 or later. For any clients who've already made donations or have donation carry forwards, the maximum federal tax savings will still be 29%. I have two slides to show us the top tax brackets for different types of income in 2015 and 2016 for various provinces. For now, let's take a close look at Ontario. If we start with other income, we can see a 4% increase from 49.53% to 53.53% from 2015 to 2016 for Ontario. This is consistent with the federal tax rate increase from 29% to 33%. For capital gains, we have a 2% increase year over year. These increases are similar for most provinces, except where there are provincial tax changes as well, such as in Alberta, British Columbia, and Newfoundland and Labrador. Our dividend scenarios have very different results. We have a jump of 5.52% for eligible dividends year over year in Ontario. The new rate is 39.34% in 2016. This is an extra $5,520 of tax on 100,000 of eligible dividends. This is a directly result of the new top tax bracket, the high gross up, and no changes to the dividend tax credit. For other than eligible dividends, it is not much better. There will be a jump of 5.17% year over year for Ontario. The new rate, again, this is directly a result of the new top tax bracket and also the impact of the change in gross up and dividend tax credits starting in 2016, with our lower CCPC rates. If we follow the cash, the net amounts to our clients are decreasing quite significantly. Let's discuss some of the personal tax planning options we could offer our clients. If we have clients who are expected to be in the 33% tax bracket for the foreseeable future, consider accelerating their income for 2015, especially if they will have similar cash needs in the coming years. As we just saw for Ontario, there is a 5.52% of after-tax savings. I'm sure many of us would take that after-tax ROI on our own non-registered investments. And for anyone interested, taxes in Alberta, they're increasing 10.69% on these dividends from 2015 to 2016. So what are some potential ways we have to accelerate our income? Well, we could sell some assets with accrued gains. If your clients have a capital gains reserve, consider recognizing more of the gain in 2015. We could look to withdraw more funds from our RIF. What about extracting additional salary or dividends from corporations for an owner-managed client? Let's take a look at the impact of doing this. I'm going to select Ontario as the province and include a year end of December 31st, 2015. Let's assume the AVI of the owner-managed corporation is $400,000, and we are considering accelerating $100,000 of income in 2015. I'll ignore employer health tax for this example, and we'll also include that our client has existing salary of $300,000, so we are calculating it at the highest marginal rates. Analyzing our results below, our client would receive $50,470 it paid a salary in 2015.